Welcome back to the Make It Count podcast. I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System. And today we have another small business owner with a lot of accounting and tax questions, I think. And that's Blaise Gregory, a good friend of mine. Blaise is the founder and principal engineer of Gregory Consulting and Control. So Blaise, introduce yourself, give us a little bit of your background, and we'll kind of get into what we're doing today while I've got a different co-host.
Sure. As you said, my name is Blaise Gregory. From Louisiana. I've been in Lafayette since about 93. Love being in this area. Graduated from UL, mechanical engineering in 08, and then started my engineering firm at the beginning of 2016, and been going strong. We do a lot of different industrial engineering, mechanical, automation, petroleum, and also some process.
Yeah, and you and I were kind of talking beforehand, and this is where the conversation got started, kind of around, so you're obviously a small business owner, entrepreneur, things are going well for you. Kind of take us into where you and I got started in this conversation, which led to the idea about what we're talking about today.
Sure. So, last year, I guess, was a little bit of a down year, but we've been growing a lot. And so trying to plan for the next year and the upcoming year and the impending, I'll say, tax bill that we think, that we know
Right.
is going to come. And, heard a lot about doing real estate and didn't know if that was something that we can do within the business,
Right.
or if it's only personal level and that kind of thing. So,
Gotcha.
and that's,
Yeah.
guess what I was asking you.
Yeah, so the reason why, it's funny, we were talking about this before, and we hadn't even planned to do it this way. Blaise would plan to just he'd text me and say, hey, I want to come see what you guys are doing,
Yeah.
watch the podcast, so to speak. And then Tyler and I were looking and said, why don't you be the co-host and let's try a little bit of a different angle, which is small business owner posing the questions, which everybody's heard Tyler pose all his dumb questions. So we want somebody with some, we're not going to say, with some better questions, I should say. Anyway, Tyler's
fresh questions.
Yeah,
Right,
Tyler's
right.
here. He knows we're just messing with him. You got that. So when you kind of started talking about that, it got me thinking too about what I'm seeing a lot on LinkedIn, which is, and other different social media platforms, where people really are starting to give, in my world, a lot of advice online. And so real estate's kind of one of those hot areas. You got a lot of bad information. You got a lot of really good information. So what I wanted to do is, from that question, just kind of paint the picture about what you can legitimately do with real estate, specifically from the standpoint of a small business owner, which is a very common strategy, small business owner operator
Right.
with real estate as, looking for owner occupied real estate. So I'll kind of start there. I'll give some of the parameters, kind of some things you can do, and I'm sure you'll have some questions. So what I see a lot of, and what can be done, which is a really nice tool, is, and very common strategy. So you own your business. Let's just say most people are formed as an LLC. And if you take that a step further, most people that are an LLC, especially in a business like yours, are an S corporation.
Correct.
That's their operating company. That's how you guys are set up.
Yep.
Okay. What I would say is, if you want to own your own real estate, always, if you got an S corp, the cardinal sin is owning your own real estate in an S corp. There's reasons for that. The biggest one being, if you ever have to take the real estate out, you would essentially have to, let's just say the best example of that is if you and your partner split up, trying to figure out how to divvy this thing up. If you ever got to take real estate out of an S corp, it's like you sold it. Even
Okay.
so, if you had to say, listen, you're going to take, it's like getting a divorce, right? You take the house and I'll take the 401k.
Right.
When you split up in an S corp and you got to distribute things, it's like you sold them. The S corp recognizes a gain as
Okay.
though you sold that asset. So you have to say, what's the fair market value? You compare that to what you paid for it. The difference is a corporate level gain that we would recognize. So we don't want to do that.
Okay.
So we put it over here, generally in an LLC. And so the structure I would advise is, you form an LLC over here that you don't elect to be an S corporation.
Okay.
And that entity has the same ownership, and this is important, has the same ownership as the operating company to which it's renting. So,
Okay.
So what you would do is, let's just say you've got Gregory Consulting and Controls, and let's just say you form Gregory Real Estate LLC. That entity will rent to the operating company.
Okay.
Very common. And then what that does is, we can then allow us to do a grouping election, and we can kind of talk about that. But that's the general kind of structure where we would rent from one entity to the other.
And that doesn't matter because I have a business partner.
Mm-hmm.
So does that matter
No,
Or just set it up the same way.
Yeah, so
both would own.
Yeah, so what I would say is the key to unlocking what I'm talking about is both entities have to have the same ownership.
Okay.
Because what we're ultimately going for, we're going for where we can create a bunch of tax losses on this. Let's just put some numbers to it. Let's just say the operating company makes $1 million, and we're like, ooh, we need to figure some stuff out. Well, what most people think, they come to me and they're like, I want to do some things. I want to try some stuff. And they're like, what if I bought a rental property? And I go, here's the issue with a rental property. If you buy, let's just say you went out on your own and bought a bunch of single family houses.
Right.
And through depreciation, that creates like a tax loss, at least on paper, right? You're not losing money economically, but on paper you are. Well, the problem is once you make over $150,000, you can't deduct real estate losses. They don't go away. They just get suspended out into the future. So you haven't created anything. And a lot of times people come to me on the back end with expectations that they have created some tax efficiencies and they're not expecting to pay as much tax. Like in that example where they might have made $1 million. They go, oh, no, but I bought 4 rental properties. It's like, yeah, but that's not really how it works. Because those losses you've created over here don't offset the income from your business. And the reason for that is because real estate is inherently passive,
right?
Subject to certain limitations, and we'll get into that. Operating income, your W-2, your businesses are ordinary income. Those two cannot net.
Oh, okay.
So the strategy I would say, while you want to be owner occupied in a separate entity with the same ownership structure as the operating company, is because you can do what's called a grouping election. So in a grouping election, what it inherently does is it makes these losses in the real estate company ordinary.
Okay.
And now they can offset the operating company.
Okay. Do those same things, I guess I'm hearing things, and you mentioned it too, like depreciation and those other kind of things. Does that still apply to the real estate?
Yeah. So I would say if we play the example forward, what we want to do in the real estate company when we buy that we buy an office building. Let's put some substance to it. We're going to go buy an office building over here. Well, what we want to do in that building, because absent what I'm about to tell you, the real estate entity really wouldn't make or lose much money. You'd pay it a market rate rent. You'd have your related expenses. This company would probably be like a break even. But what if we could look inside that building purchase and compartmentalize certain things and depreciate them faster? So most people, I would imagine you've heard of a cost segregation study.
Yeah, I've heard of it. Right.
So a cost segregation study is basically this. When you buy a piece of real estate, like with improvements on it, so a building, if you don't do anything, so you can't depreciate the component that is land, but the building component on a commercial building, you depreciate it over 39 years. So if you think about the math of that, $1 million building, let's just say 39 rounded up to 40, it's only $25,000 of depreciation per year.
Right.
Now, you could argue the property's really not depreciating, it's appreciating, but that's a different debate. So $25,000 a year is what you could take. But there's a provision that says, well, but what if some of that real estate we could say is not like structural, but it's more in the realm of like furniture, fixtures, flooring. There's provisions that allow you to depreciate things faster. And that's where a cost segregation study is. It's exactly what they do. They segregate costs. They come in and say, it's engineers. You'd probably love this stuff.
I might have to look into
you might be doing this, sir. I don't know.
Maybe we need to talk after
I know, right?
Yeah.
You might have another. This is hot right now, so they might be onto something. So what you do is you get an engineer, and he comes in and says, "Well, our study says that of the $1 million, 300,000 is this type of property. It's property that could be depreciated over 5 years or 7 years or 15.
So even like infrastructure, like HVAC and stuff, do you know it's not going to last the whole length of the building? Is that kind of stuff, is that part of it
HVAC,
too?
I think, is considered part of the structural.
Okay.
But I always think about it like floor, fixtures,
the stuff you see and touch. Kind of
land improvements, so like concrete, landscaping. Like there's a lot of stuff, but a lot of times it ends up being 20 to 30% of your purchase price.
Okay.
And so what happens is then through what's called bonus depreciation, those things that are considered 5, 7, and 15-year property, you can write them all off in the first year.
Okay. So that could be huge then, because it kind of gets front loaded.
Yeah,
where
so
you can get some of that. Not to cut you off,
no,
but
it's good.
Because the example that we're kind of talking about is, let's just say that we pay $10,000 a month in rent, right? So you can the questions that we have, do we buy a building where we have that money that we're already earmarking to spend?
Right.
But then now we have to worry about our upkeep of our building and all that. But if there's some of these other advantages and stuff too, then
Yeah.
that's not something we've been considering yet.
Yeah, and really a cost segregation is a time value of money play. That's what it is. Because it's not like you're getting more depreciation over the life.
Right.
You're just getting it way accelerated. So, but you're also doing it in a year in which you have a big amount of income.
Yeah.
And that's the real reason I say this structure, especially with an operating company and somebody who wants to own or occupy real estate, again, with both entities under the same ownership, which is key. That's one of the kind of provisions that allows you to group them. But that essentially is all you're doing is you're front loading. And in the tax world, a lot of times that's as good or better than other tax strategies because if you think about it, a tax deduction dollar is only as good as the tax it saves.
Right.
Perfect example is I had another client. He's investing in oil and gas wells. With oil and gas, when you drill a well, there's costs that what are called intangible drilling costs, where you can then say, then there's tax elections for that. You can either deduct them all or capitalize them. Well, this client, he had a down year in all of his businesses. I said, hey, why would we deduct these now? They're only going to save you like 10%. You're in such a low tax bracket that the deduction is not worth much. Let's capitalize. So he's the exact opposite. I want to send his deductions out into the future because I know he's going to be making more and he'll be in the 22, 24, 32, 35% brackets where that deduction saves him way more money.
Yeah.
Now, admittedly, on that, there's a time value of money too. But I'd be willing to take my chances on a little lost time value money on a 10% deduction versus a 37%.
Okay.
On this, you're the exact opposite. You're getting a time value of money and you're saying, but this year's probably a really good year, maybe relative to others.
Right.
So now's the best year to do it.
Well, I guess going back to your example, did I just start a clock? Meaning that if I get this bonus depreciation and everything else, and with 5 or 10 or 15 years, does that mean that it's set for that next 5 or 10 years, or can I also pause it or delay those kind of, I guess, like you're saying, tax savings to another year?
Yeah. So when you segregate the property into the 5, 7, and 15-year property, and then the remainder is the structural that's over 39 years, you're going to take now the rule is 80. You can deduct 80% of that in the first year.
But the bonus?
Yeah. So the bonus depreciation rate is 80%. So in 2022, it was 100. It was the last year of 100.
I got you.
It's going down 20% a year. At least that's what the law says right now. So in 2023, it's 80%, 2024, 60, and so on. So on that, let's put some numbers to it. Let's just say you bought $1 million building. And forget the component of it that's land. Let's just assume that what you can depreciate is $1 million. Maybe the building's 115 and you determine the land's worth $150,000. So you're sitting there with $1 million to depreciate. And then a cost segregation engineer comes in and says, well, we've found $300,000 of items that could be accelerated. Okay. So in that example, you're going to get to write off $240,000. The $300,000 times 80%. Now the balance, that $60,000, is divided up amongst 5, 7, and 15-year property. It's now subject to being depreciated over 5, 7, and 15 years.
Okay.
So you're stuck with that.
So it does start that clock.
It starts that clock, and now that light fixture that was 5-year property, you deducted 80% of it. The remaining 20 is depreciated over 5 years.
Okay. Well, what if, I guess, 5 years into it, I do some other building renovations or something? Does that change anything on that cost segregation?
Yeah. So what you could do right now, what they have is called qualified improvement property.
Okay.
I cannot remember if that's going away. Like that was a lot of this stuff came up in the Tax Cuts and Jobs Act, like the Trump tax cuts essentially. Yeah. And they had this category of property that says if you improve a commercial space, then it's a 15-year asset, but you can write it off fast.
Okay.
So yes, as it stands now, if in a couple of years you do some major renovations, there's some real arcane rules, like it can't enlarge it, it can't be for an elevator. It's like I forget the exact requirements, but suffice to say, 3-4 years, you're like, okay, that building we bought, we want to remodel one floor of it.
Yeah.
that would qualify for this, subject to whatever the bonus depreciation rate is at that time.
Okay.
So if in 3 years it might be 40%,
Right.
but it would still follow this
So
same.
you can
line.
still kind of get the
Yeah.
same thing, and you'd already have the cost of what it's there because you just paid for it.
That's right. Yeah, easy. It's an easy cost segregation
Yeah.
at that point because you're telling the engineer, this is what I paid to improve the property.
Gotcha.
Now they may have some allocation to say some of what you did improved the structure, maybe. But I would say in that example, most of it would be considered like kind of tangible stuff.
Okay. Does that matter at what time of the year you do it? Like, is it something if let's say we bought a building December 1st.
Yeah.
You know what I mean? So it's a month into the end of the year. Does that change anything?
No.
So you still get the bonus depreciation for the entire year?
Yeah.
Wow. That's interesting.
Yeah. One thing, well, let me back up. That's not 100% true. One thing that could change is, and I'm trying not to get too much in the weeds on this.
Sure.
There's a way that the remainder of what you couldn't take bonus depreciation on gets depreciated. So that remainder wouldn't be the December date would factor in, but only on the remainder portion.
Okay.
So if you bought it in January versus you bought it in December, yes, there's a difference, but only on the portion that you didn't get accelerated.
Okay. Which
is
is going to be 38.
again, which doesn't matter
38
that
some
much.
years
Yeah,
or whatever.
correct.
Years. Okay.
Yeah.
Gotcha. So I guess the other thing I was thinking of too as well is what if 3 years from now, we've accelerated this, it worked out great, but maybe we have a down year.
Yeah.
So, and I can't claim, like I'm not able to utilize, I guess, all of the depreciation. What happened? Does it kind of wait for you or something too? Or do you?
Yeah. So this is, so let me kind of,
if I'm asking that correctly.
Yeah. Let me walk you through the example from the first year. I think it'll make sense. So the reason, and I'll kind of come back to where we started, real estate in the tax code is what's called inherently passive. Okay. So what that means is if you create a real estate loss and you make over $150,000, like your adjusted gross income, you can't deduct real estate losses.
Right.
Okay. So we're circumventing that rule by doing what's called a grouping election.
Okay.
So, and there's another kind of rule. When you rent from yourself, which is what this would be called, what's called a self-rental. Normally a self-rental it's funny how it works. If the real estate LLC rents to your operating company and it makes a profit, that's considered it's active income.
Okay.
If it loses money, it's passive.
Okay.
Okay. That's the normal treatment. So there's all kind of rules. When you group the two, you basically discard that treatment and you say, now the real estate, no matter if it makes money or loses money, is active, and which the whole point, because if you do a cost seg and create a big loss over here, it can offset the income from my active business and my W-2 income.
Gotcha.
Okay. So in the future, if it's still losing money on paper, just because for whatever reason, because of that treatment, you're still able to deduct those losses.
Oh yeah. So it's just like your normal, ordinary.
Correct. It's really like one of those places in the tax code where it's like, because real estate trips people up.
Yeah.
Especially high income earners. Let me back up. When they're doing it for a tax motive, they're like, I'm going to buy this real estate because I killed it this year in my business.
Right.
But it's like, yeah, but it won't because it's passive.
Right.
Your income over here is not passive. Well, what if I could take my real estate losses, make them non-passive? Oh, and then what if I could then make them bigger losses? Cost segregation, grouping, rent to myself. Like kind of starts to check all the boxes.
Yeah.
One thing I would say is, and you're probably thinking this is down the road, though, it causes an issue, is that you got to keep this property now.
Right.
Because if you sell it, you got to you familiar with depreciation recapture?
Correct. And I guess I've heard of 1031 exchanges on a personal level. Is that something you can do on a business level too?
Yeah. So if you basically took that $1 million property and let's just say we've depreciated it down to $600,000.
Right.
And we go to sell it for $1.5 million. Well, we don't have a $500,000 gain. We have a $900,000 gain.
Right.
Because the way to think about depreciation recapture, and most trips most people up, is that basically what you're saying is the property didn't economically depreciate. In fact, it appreciated.
Right.
So you shouldn't get the benefit of writing off a portion of the property and then paying no tax when you sell it.
Correct.
So that's kind of the thinking there. So and you could absolutely do a 1031 on that. So on the back end, you could be like, perfect example, you buy a building, you grow out of it.
Right.
Well, what happens is on the back end is that you then sell that thing and then you got to go buy. A 1031 is essentially you buy another property at or greater than what you just sold, and you can defer the gain.
Okay.
So the gain that you would have, and there's other criteria too when you have done a cost segregation study,
Right.
But suffice to say, you got to buy something for at least as much as what you sold for, and then the gain that you would have recognized just gets rolled into the new one, subject such that the new one has a lower basis.
Okay. I guess can theoretically buy another building and keep that one, same ownership and everything else, but you're renting it out, not renting it to your company. Does that throw a kink in things too?
Well, did
I ask that correctly?
No, that's good because it's funny. I don't know if I've ever been asked that question. So it's like, okay, I got my operating company.
Yeah,
we bought one.
We grew out of it, like the scenario you said.
Yep.
And so I'm saying, well, I'm going to buy another one, but I really like the way that this was working. I'm going to start renting it out to another, startup company or something of that nature, and then have another building that we've moved my operating company to.
I think this is why I'm glad we're doing this, because it's going to make me kind of think on the fly. I think what I would tell you is the old building now is not, I think we'd have to think about the grouping there. Would the old one, would we have to change the grouping and no longer be subject to this kind of regime we have? But we'd bring in a new one. So the old one would now be passive. I'm thinking it through.
I understand.
Old one now reverts back to the old real estate rules. I think I'd have to think about if we'd undo the group. But the new one, we do the exact same thing.
Okay. Well, then, along those same lines, what if there was two different type of real estates? And I guess the question that I'm having for this example is, so we talked about the building that we're operating again, but then we also, in my business, we have some people that are remote. And so I paid to bring them in town and I put them up in a hotel.
Yeah.
So there's a certain amount of that cost that I'm looking at is, can I buy a townhouse or something and do the same thing?
Yeah.
I'm using it. Both of them are for company business.
Right.
Are you limited on the amount if they're all, can you group all three of them together possibly?
Yeah, you can, because what you're saying, the rules basically say, do these entities, or let me back up, the term is activities. Do these activities form in what's called appropriate economic unit?
Okay.
And you could argue they do.
And they
do.
Yeah.
I mean, they're real estate activities feeding the operating company's operations.
Right.
So absolutely. I mean, if I hadn't even looked into that, but if we were doing this, I would say yeah, because they form an economic unit. You're renting an apartment absent this.
Right.
All you've now changed is that you moved apartment rent to a townhouse ownership.
Correct.
Or whatever, a condo or something, or a single family. But yeah, do the same thing.
That's interesting.
Yeah. I hadn't thought of that one though. But it makes sense.
Yeah.
I mean, it is an economic unit. Again, kind of checking those boxes of let's just say maybe you bought it in the same LLC, or if you bought it in another one, you would want that ownership. Because that's one of the criteria, is that they form an economic unit, the same ownership structure on both sides. And there's a term called they're insubstantial to one another. And you could argue my operating company, my real estate that rents to it, is insubstantial compared to one another. And honestly, I don't think the tax code even really defines that term.
Okay.
But that's how I would do it.
I would have never even thought of that. That's interesting.
Yeah.
And I don't want to change the subject too much, but is that kind of how owned autos play into it too, or is that just completely different? Like, are those? And we don't have to.
Yeah, no.
Just kind
So
of a
if
quick
I
question,
get
I guess.
autos, the difference would be is you would probably have them in your operating company.
Yeah.
And so they wouldn't even be subject. There's no limitations.
There's no
other than
advantage.
basis and different stuff like that.
Okay.
You wouldn't have this passive, non-passive distinction. And that's really what you're getting around when you do the self-rental and then you group them, is you're saying, I'm getting around all those rules that say if I create a loss in real estate, I can't deduct it. Because the holy grail is you buy a property on the last day of the year, you hadn't even made a mortgage payment yet.
Agreed.
And you move in, let's just say, and then you gotta place it in service, which means you gotta occupy it.
Yeah.
You move in on the last day of the year, you haven't even paid the mortgage yet. You can get a $300,000 deduction. That's awesome.
That is great.
Because you haven't even spent any money yet.
Yeah.
I mean, you leveraged it. Like it's the total like power move on that example. Like this is what everybody, when they hear like on the TikTok schemes and they're like, all my clients are always texting me stuff like, can I do this? It's like, no, you can't put your house in a trust. Like, like they're always asking me all these like, can I do this and that? It's like, but this is legit.
That's awesome.
Yeah.
I guess one final question on that. Do you know, what if I buy let's say I buy a bigger building, right? And I can't quite fill it up. can I sublet it out to another company that would still be kind of considered grouping? It shouldn't be. Okay.
Yeah. In fact, that's what I'm doing. So I'm under contract on a building and we're going to occupy 60% of it.
Nice.
But it's still, in my eyes, an economic unit with my operating company.
Yeah.
I'm there. I'm working in it. This would feed. I mean, I haven't even really thought twice about it. Honestly, I'm doing this strategy on the building I'm buying. I'm grouping them. I'm doing a cost segregation study. Like I'm kind of practicing what I preach.
That's awesome.
Yeah.
I'm sure I'm going to have more questions in the future, but this is great.
We'll have to bring you back on that. We have to bring you back for part 2.
Hey.
No, but this is good. This is what I was saying, like, because I'm not thinking through, or at least I can't anticipate every kind of, I would say, practical question.
Right.
Because for me, in CPAs and anybody doing technical stuff, you're working off of a bunch of assumptions. Like I'm on the step 10 and you're like, well, thinking about this, and this. It makes me bring back and think about those things such that I can explain it in a way that makes sense to people, So, no, this is good.
I appreciate it.
All right, so you're going to come back for a second?
Yeah.
All right, cool.
If you'll have me back.
Yeah. We'll have you talk about, after you do this strategy.
Sure. No, that'd be great. We'll have a little follow-up,
Yeah, how's it going? So,
sure.
Blaise, appreciate you coming.
Thanks for having me.
What do we normally say, Tyler? If you want to find more episodes, if you want to hear more about what we're doing, go to mire.group. It's got all the podcast episodes. Yep. If you want to find me, best place is LinkedIn, Marcus Mire, Mire, and we'll see you next time.
Awesome.
Thanks.
Thanks for having me.